Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today is Mark Burgess, Deputy Global Chief Investment Officer and Chief Investment Officer EMEA. And we're going to discuss some of the key themes driving markets. These include geopolitics, the current state of play in equity markets, and our views on credit. Mark, we're seeing markets continue to make near-time and all-time highs. How would you describe the current investment landscape?
Well, it's a pretty positive one. We're going through a sort of relatively unprecedented bout of coordinated global expansion in terms of economic growth. If one looks around the world, clearly growth in the US is pretty robust. I think Q3 GDP just came out at 3%. We've got growth expanding in the European region. Probably won't reach the giddy heights of 3% that we're seeing in the US, but will certainly be 2% plus, I would think. We've got very stimulative monetary policy still in Japan following Abe's re-election, which is stimulating the Japanese economy, and that's beginning to grow nicely. We've got ongoing growth in China. We've got growth in the rest of Asia, not least of all because of growth elsewhere in the world. Really only in the UK is growth kind of moderating, but outside of that, growth is pretty positive, and as a result of that we're seeing corporate profits being driven forward very nicely, and it's a very supportive background for investment markets. So I'm not surprised that equities are trading at where they're trading.
And geopolitics has been a significant feature over the last 12 months. How do you see that impacting markets as we move forward?
Well, it remains a factor. We've got Catalonia kind of bubbling away at the moment, which has the potential to undermine European coordination going forward. At the moment, markets are pretty sanguine about that, but clearly that has the ability to be quite impactful for Europe and the cohesiveness that we've seen from Europe over the last year in response to Brexit. So that could be challenged. Abe's just been re-elected in Japan. That's very positive for the Japanese equity market, and we think that we'll see additional bouts of monetary stimulus as a result of that. Clearly what happens with Trump going forward is pretty important. So, the sort of promised tax reforms that appear to be getting nearer and nearer and nearer, though not quite here yet, have the ability to be undermined by the most recent developments in terms of his ability to execute. So watching that very closely. So it's an ongoing feature and one that has the ability to impact markets. And then in the UK, you've got the Brexit negotiations and the risk of a hard Brexit kind of growing, and that has the potential again to impact the economy and markets. So again, pretty important.
And with respect to equity markets, how is the earnings season playing out? Are there any key themes emerging, and what markets do we currently favour?
Well, I'd say sort of more broadly, earnings revisions have been pretty positive. You've got the odd miss, as one always does have, but largely companies have been beating expectations, certainly meeting expectations. I guess the one area that really stands out is technology, particularly in North America. So whether it's Amazon, whether it's Microsoft, whether it's Alphabet, the old Google as we know it, all beat earnings by a significant proportion last week. These are big companies, big market constituents, and so when they beat earnings forecast by as much as they have done, that makes investors sit up and take notice. Despite that, we think the US market looks pretty up with events. There were interesting stocks that one can find, but the US equity market looks pretty fully valued to us. We continue to like Japan. I've said a couple of times about Abe's re-election. We think the Japanese equity market can be kicked on further from here. Very positive earnings revisions coming out of Japan. And Europe remains a favoured market. Growth is still picking up. Catalonia aside, we think there's some decent positive momentum. And then in emerging markets in Asia more broadly, it's always been a good play on global growth. Again, we're seeing positive earnings revisions, and we continue to favour that region.
Now, Mark, we have been underweight the UK market given Brexit concerns. Do these still hold?
Yeah, the one exception to everything I've been saying from a positive perspective is the UK market. We've seen probably more earnings disappointments in the UK. There's no doubt that the domestic economy is slowing. The Brexit uncertainty is a big concern for those that invest in the UK, whether it's companies or investors. The trade talks that are yet to start really do provide a very uncertain framework for people to make decisions on going forward, and I think that is slowing economic activity in the UK. We've got the prospect of an interest rate rise coming through, and the consumer's been a big driving force to the UK economy. Again, that's probably going to temper the consumer's enthusiasm for spending. So I think the UK stands out. From a valuation perspective, it doesn't look that expensive, nearly 4% yield and sort of 14.5 times PE. But the earnings momentum is just much less attractive than it is in other markets.
And we have talked in the past about how credit is looking increasingly expensive, and we've taken some money off the table, specifically in high yield. What are our views now?
Well, all of the positivity I've been expressing about economic growth and corporate profits clearly are as important for credit as they are for equities. What I would say, though, is that credit valuations feel to us to be much richer than equity valuations, and high yield in particular is very difficult to now call it high yield. Yields have fallen by so much. We're not seeing lots of bad things coming through in terms of whether it's corporate delinquencies, whether it's companies really leveraging up, or whether it's the companies doing very un-bond friendly stuff. So I think that stops us being very, very negative, but the valuation really does leave us little upside, we think, in high yield. In credit, I think investment grade credit, we think there is probably still more upside than there is in core bonds, but it's becoming quite a marginal call. So it's an area of the market we continue to watch as valuations get richer and richer.
Mark, thanks very much.